Hi, welcome back. In this week's conversation, we talk about calculated risks, assessing the risks, identifying the benefits of those risks, and in the end, making a balance and make a decision. So stay tuned. And we continue our September conversations about money and investment. And this week we talk about calculated risks once again. And in this first segment, assessing our risks. Well, in our first conversation, I mentioned Chris Lasker's money quiz and my lack of confidence and, in fact, my fear of investment. That's why I've been a non-investor all my life. And last week with George, we spoke about tolerance to risk, which also I came to the conclusion, which I already knew, that my tolerance to risk was actually zero. I have very little or no tolerance whatsoever to risk, and that's why I've been a non-investor. But that actually, it's not a positive thing for me because in my view, it may have been blocking my decision-making process, and maybe I refused to do some things that could have given me some results, and I could have had some returns of some investments, or I could have made some decisions that could have been a bit riskier, yes, but in the end could have given me the results that I wanted, and it would have been very positive. And that's the negative of being so fearful like I am. So today I'm talking about assessing the risks. First of all, I think before we start assessing any risks in regards to an investment or a decision we're making for our companies, we should assess ourselves first. Because most of the times it's not investment, it's not the partnership or whatever decision we want to make in regards to our business that is the problem. The problem is us. We are the problem. Definitely, I am my own problem. I was my problem. I was the cause of a lot of these bad decisions because of this fear I had of investment, this fear I have of taking risks. So we should analyze ourselves. We should analyze what is our tolerance to risk, what is our perception of risk, and then we can actually identify the issues within us in order to work on them and be more able to fight this fear and have a healthy investment life. Once again, I do recommend Chris's money quiz because it is a life changer. You will find that in those tiny little questions that you answer, and they are very simple questions that is just a 1 second answer because it's straightforward, but the results you get from that, it's a mind changer because you will see how your personality actually is interfering with the way you deal with money, you perceive money, and you make decisions in regards to money. And that's very, very important. Sometimes we may be making the wrong decisions because we have that archetype there that is actually blocking us. I certainly do, and that's why I'm making these videos this month, because I would like to share my experience with you, and maybe we can set a strategy together. And that's why in this first segment of today's conversation, I set up that we should analyze ourselves. We should analyze our cultural background, our family background, what was there when we were growing up, if we were in an environment that was always, oh, you shouldn't take risks, oh, you should save, oh, you should not invest in shares, blah, blah, blah. Because sometimes that's what happens, and you grow up with that perception that, oh no, money is not to be invested, money is not to be gambled, money is to be kept and accumulated. And sometimes that's not the best thing because, for example, and we spoke about it last week, if we have money in the bank, it's not giving us anything. because basically the interest rates, as George said, interest rates are below inflation, and basically our money is devaluing there. So we're not getting any money. We're just having it there. So it doesn't mean anything. But for example, if we have a healthy investment, like it might be on the stock market, or it might be in the real estate, or any investment that you fancy, we might be getting returns. Yes, there is risks involved, but we need to deal with those. And before we deal with those, we need to deal with ourselves. And I think that's what I need to do. And that's why I'm doing this video today. I think we should assess ourselves. We should assess what within us is blocking us from making the right decisions. And then we assess whatever investment or whatever decision we want to make to our company. And then it's very simple. We just make a little chart, and on one column we put all the risks involved, another column all the benefits. So it becomes a document, and that's something more familiar for a business person like me. You so used to look at charts, you're so used to look at reports, and once you read the chart, once you read the report, it becomes a little bit more distant from your brain, distant from yourself. It's not personal anymore. It's like a chart over there. And the business person in you just kicks in, and you can look at it with a more objective mind. And that's what is important. It's important that you analyze yourself and you know what is wrong, what the issues are, why you're not investing the way you wanted to, and then you analyze the risks. And that is the main thing, is you analyze yourself and analyze your risks. So we fill up the column with the risks. Now let's fill up the column with the benefits. I think that's the best way to put things. Now we should look at what that investment or partnership will bring to our company or to ourselves. Let's say the share market. We may put the minimum $1,000 that George recommended last week. And the share market always tend to go up. Yes, there is days that will go down, and you may, let's say, buy shares in the value of $1,000, and then 1 week later they went down and they only worth, let's say, $995 or something like that. Don't panic, as George said. Hold on to your shares for a little longer, unless, of course, you know when you read and you did your research and you know that something is wrong with that company, and then the best option would be selling. But obviously, I leave that to our commentator last week. But there's always one day or another that it might go down slightly, but then they will go up. And if you look at the share market every day, if you look on the news, there's always the financial segment. And if you look at it, let's do this exercise. If you look at it for 1-2 months, you will see that. You'll see that the share market just goes up and down. And there was one day that may be very high, but then another day that may be low a little bit, but then goes up again. And it's not always that bloodbath, like they call it, every day. And yeah, that is a risk, yes, of course, but it's not something that happens every day. So we should look at the benefits. So it's the return that we get. Having money in the bank, it's not getting us anywhere, because the current interest rate, as George said, is below inflation. So our money is devaluing there. So if we put it on, for example, in the share market, we may be getting return. We have a return above inflation that it's much better than having it in the bank. A partnership. Maybe that partnership is going to give us exposure in the market. Maybe that partnership will give us a bit more prestige in the market. It will give us recognition, and that will ultimately translate in more clients. So it's a positive thing. Yeah, there may be an investment associated with it, but I would say that the benefits of it are really, really good. We should also look at all the positive aspects of things, like the investments or the decisions that we're making. What are they bringing to our company? What are they bringing to us? And once we do this, and once we have all these benefits listed, it's much easier for us to make an objective decision because it's all listed. We're dealing with documents, we're dealing with reports, we're dealing with charts, which is what we as business people are used. It's what we are familiar with, and that allows a little bit of distancing from the decision and make it a little bit objective. At last, we have both columns there. All we need to do is make a balance. We need to look at the negatives or the risks, the positives or the benefits, and then weigh them all and see which ones are weighing down and make a decision. It might be or it might look very simple, but obviously it's never simple, and especially if you are someone that is so fearful of risks like I am, it would obviously be something that might look difficult. But if you look at it in an objective way, like I've been talking in this conversation today, it may clarify a lot of things for you, and it may make it easier for you to decide. For example, when you look at a chart or at a column or whatever you do in a paper or a report, it sounds more familiar because that's what you do as a business person. You're always dealing with reports and all sorts of reports, all sorts of charts, all sorts of information that come to you when you make your decisions based on actual facts and things that you're reading and making your research and so forth and so on and so forth, etc. So I think when you look at it from a distance, let's say, it makes it easier because then you see there is an investment, but then it's going to give me exposure. That exposure will translate in clients, and those clients will translate in revenue. So this is the expense, but this may be the revenue. So maybe the revenue outweighs the expense. It's a $1,000 that I'm investing in the share market. Oh, the share market may go down, and in a week I may have just $950. But let's say the share market goes up again, and in 3 or 4 or 5 months I may have 1,100, and that's very positive. And that's what we need to do. But on a distance, we need to be objective of evaluating things and not inflating things, not letting our emotions block us from making the right decisions, which was certainly what was happening with me. So if we do it, if we look at that little chart of yours, a little table that you created, and you see, okay, this is what I've got, these are the risks, these are the benefits. And then, of course, I'm not saying that in every decision or in every investment, you're going to come to the conclusion, I'm going to go ahead because this is positive for me. No. And the total purpose of this exercise, it's exactly to ascertain which is the best option for you. And that's what George said. You have to acknowledge your risk factor, you have to acknowledge your tolerance to risk, and then choose the investment that is suitable for you. Sometimes you may need professional help of a financial advisor, but for your company, if it's a partnership or something, You may also have a business advisor that may give you some clues, but most of us actually have to make the decisions on their own. But if you actually assess all these things, and if you are if you know what is your personality and all these things, you will be able to make obviously an informed decision and a much better and balanced decision for yourself and for your company, because you know exactly what's there, and you know exactly what you shouldn't be doing and why you should be different, and what was blocking you before and what you should be changing not to be blocked anymore. Sometimes you may come to the conclusion, no, the risks are too high. The benefits I'm going to get from this may not be as big as I first thought. Maybe it's not a good investment for me at the moment, or maybe this is not the right decision for my company at the moment. Yes, that will happen. It's part of being a business person. But in the end, you analyzed it. You saw it with a more objective eyes and in a distance, and that allowed you to actually see it as it is and not how your emotional self perceives it. I think that is the main issue here, is that we take a calculated risk. Once we do this exercise and we analyze the pros and the cons of that investment or that partnership or whatever we are doing, and we know the risk is there, but the benefits are also there and they're bigger than the risks, and we go ahead, that is what we call a calculated risk. We know it's there, we calculated it, we are aware of it, we know it may happen, but still we choose to go ahead because in our mind, after a thorough analysis, in our mind, that risk is outweighed by the benefit. And that is what it is, a calculated risk. And that's all for today. I hope you like our conversation. I hope it really helps you have a little understanding of how we should deal with this risk factor. For me, it's a learning curve. I've been learning a lot in the last few months, and of course everything that I shared here is also and solely my personal experience, and once again I say should not be taken as financial advice. I'm not a financial advisor. As I said, I'm learning myself, and I decided, why couldn't I share with you while I'm also learning, so we can do this together. So I hope you liked my video today. I hope you liked the ideas that I've given you. And if you have any questions, if you would like to share, maybe you are going through the same process as I am, and you would like to share your views and your strategies, why not? Just share with us. And of course, share with your friends, as I said. Share with your friends so we make our conversations even bigger, and subscribe the channel so you get a notification of every conversation every week. I hope you like this one. Have a wonderful week. See you next week. Thank you very much for watching. Bye.